Hi traders, sorry about that technical issue there. Welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is generally a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Well, I'll just let you have a quick look at the disclaimer that I need to show you. I'll just give you a few seconds to briefly look through that, which I have to do. And then we'll get to what we're going to talk about in the next 30 to 40 minutes or so. As I said, we'll focus on, well, currently where we are to kick off this week, busy week with lots of risk events, data, and of course the underlying trade theme, rocking markets at the moment, actually. So we'll look at that, some brief thoughts on where we are, as I say. We'll then just check out what's been happening in markets. So we'll look at NVIDIA's results, we'll look at the chart, and just run through a quick summary of what came out of NVIDIA's results last week. After that, we'll look at US stock markets and the technicals around some of the charts, just to see where the key points are, key levels are for us and what we're looking at. Before then, getting into last week's main event, so we'll look at the US inflation data, the core PCE data briefly. We'll look at the RBNZ meeting and look at the Kiwi dollar, as well as Japanese, well, Tokyo CPI actually. So we'll look at dollar yen as well. After that, we'll look at this week's main events. So that will be, of course, non-farm payrolls on Friday. Lots of jobs data before that, of course, out of the US. We'll preview the ECB meeting as well. We do get inflation data out of the Eurozone on Tuesday, so brief summary of what's expected there. And also then the Bank of Canada meeting on Wednesday, which should probably not bring about another rate cut, but we'll get into more details on that and look at dollar CAD as well. Euro dollar, of course, and the DXY. Will be going through all those charts as we go through some of the previews for the data this week. Okay, here it is then, just what we're hoping to look at, as I say, in the next 30 to 40 minutes or so. Currently at the moment, of course, as I've mentioned, trade-related uncertainty continuing to hit market talk this morning. As a summary, obviously this can change, and we know things can change very quickly. President Trump, well, he announced that he was going to raise the import duties on steel and aluminium from 25% to 50%. That's starting on the 4th of June, so Wednesday. We've had a sort of tit for tat with China really going off over the last 48 hours or so. So Chinese officials basically have equally accused the US of violating the consensus reached in Geneva. I think Treasury Secretary Scott Bessent actually had said the same thing about China last week, late last week. China had come back, as I said, tit for tat. This pretty much to be expected now after kind of a deal was a deal in inverted commas was agreed, but obviously now things kind of getting a bit hotter, a bit more tempestuous, should we say, volatile really. So Chinese officials equally accused the US of violating the consensus reached in Geneva, as I say, warning they might take additional action to defend their interests. All in, really, this is a flaring up of trade-related tensions, and that has caused risk-off buyers already to kick off the week. So Nikkei down over 1%, S&P futures down 0.4-0.5% or so, and the dollar certainly losing ground, down over 0.6%, really losing against the likes of the yen, of course, safe haven currency, really, Swiss franc and euro as well. Just checking where the euro is, above 114. Also sterling against the dollar, cable, that's above 135 as well. Not new highs, but close to there. So lots of uncertainty again. Hardly helping US Treasuries actually, with yields even rising a touch this morning. And that just all adds essentially to what we had last week. Again, more uncertainty. The US Trade Court, just to recap, actually ruled against tariffs imposed with the authority of International Economic Emergency Powers, that act, but the product-specific tariffs imposed under another section were not part of that ruling. Just remember that, really. And as such, we probably see more product-specific tariffs replacing the current countries specific measures. We talk about this in our week ahead, actually, and certainly if the US Supreme Court ends up confirming the trade court ruling, which may take quite a few weeks actually into the summer. Um, all in, of course, legal challenges really do get messy, just introduces more uncertainty into ongoing trade negotiations, really. And really now, of course, then all US trading partners now essentially reassessing what their most likely outcomes are. Um, yeah, lots of confusion. It's tough following some of this, and for us it is. We're following markets obviously second by second, really, with lots of news and headlines feeding into some of our platforms. So yeah, it is tough. So just well, from experience, really, it's about risk management, checking the size of your trades for sure for us, and just being aware that we can get whipsawed in either direction sharply on sort of headlines. We call it headline havoc, of course, which where you can look great for a few minutes and then that reverses quickly. So yeah, a lot of things going on even and in amongst the trade related headlines, of course, US China, US Europe, of course, eyes on that, and then of course, these legal rulings as well in the US itself to look out for. Although, as we said, that could take some time with the Supreme Court now involved as well. Yeah, just some thoughts on that. Let's move really to safer ground in a way. And Nvidia, we just pull up the chart first of all. Their results obviously out last week. Let me just grab the chart 1 second. Which is here. Let's just get rid of that. So yeah, they delivered strong quarterly results actually, in summary, driven by robust AI chip demand, of course, the successful Blackwell rollout, expanding customer diversification, although they were obviously hit with an $8 billion revenue hit from US-China trade restrictions. Just on the numbers, remarkable quarterly revenues again, 44.1 billion, was up 69% year on year. That comfortably beat analyst forecasts. The data segment, center segment, that also soared. That's central to Nvidia's success, of course, soared to 39.1 billion. That's a 73% increase year on year. And that revenue actually from data centers now dwarfs actually all of its closest rivals combined. That really underscores then Nvidia's dominance really as the preferred supplier of AI infrastructure to, of course, then tech giants like Amazon, Microsoft, Alphabet, Meta, who are spending really hundreds of billions on this AI rollout. Really, gross margins again really huge, really 71.3%. That is excluding the China-related inventory charges, and it all underscores really Nvidia's robust operational performance. And they did guide for next quarter revenue of 45 billion, broadly in line with analyst expectations, and that is despite that anticipated 8 billion hit from China restrictions. Bottom line, really, Nvidia, it occupies kind of a unique, complex position. So it's sort of in between geopolitical tensions, of course, with US China, but also then it's at the sort of transformative AI innovation space, if you like. Risks are, of course, from China, they're significant, but so too sort of strategic opportunity it does have globally then, as kind of evidenced by potential new partnerships that we potentially may see across the Middle East, of course, and with Saudi Arabia. Probably the immediate challenge for Nvidia really, and therefore for investors, is, well, the company navigating those geopolitical storms really while delivering, of course, on its ambitious technological roadmap. And certainly any missteps or unforeseen disruptions, certainly from tariffs as well, may swiftly change investor sentiment. Going forward, then, I guess we look at Nvidia's margin recovery trajectory. That will be important. Further expansion beyond the hyperscalers we talked about into other, of course, diversified industries, and then strategic responses really to, of course, the intensifying competitive pressure that we are hearing from Chinese AI innovation as well. So just some thoughts on Nvidia there. As for the stock price and the chart, where are we? You can just see, well, we've got fib levels in here from that high at the start of January down to that low in April, low at 86.62, and we're now at 135.13. So decent rebound, and we'll show you measures really matches the stock rebound that we've seen in the wider indices, which we'll get to shortly. So we're back to, well, we got up to the 78.6 retrace level actually at 138, just above 138. Got through 140 and then pulled back, that you can see here. Below here, you've got the 61.8 of this move down. That's at 127.72. Pretty close to that. That black line you can see is the 200-day moving average. That's at 126.77. So should be decent support around there, and that tallies then with that swing low from late May at 129.16. So sort of zone of decent support, you would think, and then of course key level from last week's high 143.49, and then above that 153.13. Okay, that's the chart on Nvidia. As for US stocks, if we just look at well, just before we get to US stocks, actually, I've just got another chart I'd like to show you. So bear with me one second, and it's just really just a compilation actually that Reuters put out of the rebound that we've seen generally in global stock markets. Hopefully you can make out the different markets across the globe, as I say. So you've got the US indices here. This dotted line is Liberation Day, essentially. And then you can just see the rebounds, the V-shaped rebounds that we've seen across all different stock markets. So you've got the US, S&P, and the NASDAQ here. Nikkei, of course, Japanese index, the SX as well, Stocks 600, the European Stock 600, and then the DAX, actually the one that has beaten those previous highs, and yeah, is pretty strong and outperforming the other major indices across the globe. So really interesting times, really quite surprising, strong rebound, of course. Certainly retail investors getting involved very heavily, and I know we've written about it being the sort of most unloved, one of these most unloved rallies, if you like, risk rallies, as sort of fund managers loath to jump in, but then obviously having to, as they miss out on performance. Yeah, we are where we are now, and obviously got headwinds, and it's interesting, sort of so many headwinds, and yet this great big rebound that we've seen, and certainly as well, Mag 7 have been leading that. So obviously those are the mega cap tech giants, which had given up sort of leadership at the start of this year in the major US indices, but now reasserting that dominance again. And of course, decent results like Nvidia's certainly helping that theme, if you like. If we just look at some of the technicals then around some of the indices, the major indices, these are, of course, in the US. So let me grab a couple of charts. I should say as well, while I'm doing this, if you do have any questions, I should have said at the start of the webinar, then please do ask them in the chat box. I think you can write any question there. What we're looking at the moment, or anything you're looking at potentially, and yeah, more than happy to look at try and answer any of your questions. We have a really good showing actually of a number of people on the call at the moment, so really do appreciate that as well. This is the S&P chart. You can just see, where are we? Similar, as I said, to Nvidia in a way, big V-shaped rebound. The 78.6 of this move lower, that's at 58.66. This is the S&P 500. And then you've got the recent high at 59.68, just short of 6,000, with the all-time high at 61.47. Again, support, well, you've got the black line, the 200-day moving average, obviously widely watched. That is at 57.85, and then you've got the grey line, actually 100-day moving average, just below that at 57.66. And that tallies with that swing low again from late May at 57.67. So yeah, decent support should be around there, as long as we can. Well, I was going to say as long as we can hold around here, looks like bullish consolidation before we move higher. If I just switch to the futures, though, you can just see, yeah, we're down 0.4%, but we're still sort of hanging around some of these key levels. So, yeah, interesting whether we do hold that or certainly we hold around the 200-day and 100-day moving averages in the S&P 500. Just pull up the NASDAQ as well. Similar chart, of course, V-shaped rebound. We're just off now the that high from last Thursday at 21,611. You've got the 78.6 retrace level at 21,000, just above there. But then the 200-day and 100-day just a touch lower actually compared to the S&P, for example. So they're at 20. You can just see 20,393 and 20,365. Yeah, and then you've got the Dow underperforming, really, tech underperforming then the Nasdaq. So you can see we're now below the 200-day moving average, just trading around the 100-day. Those are at 42,406 and 42,258. And then below that, we've got this 61.8 retrace level up 41,829. That is the Dow Jones. Obviously, more defensive and cyclical, more defensive stocks in this index as opposed to the Nasdaq, of course, which is far more tech heavy. Okay, those are stocks. Let's now briefly go to just a very quick rundown of what we saw last week. So US core PCE numbers and also the RBNZ. The core PCE, this is a key number really, and we like to focus on it. I know everybody looks at CPI, but this is the Fed's favored inflation gauge, a broader measure of price pressures really. So important for markets. You can just see, really interesting. This is a chart, of course, courtesy of an investment bank, actually ING, but you can just see how you've got the month on month, the blue bars there, changes. You've got the grey line, which is year on year, and then the 3-month annualized, which is the orange line. So pointing lower, slowest rate actually month on month and year on year since March 2021. Came in at 0.1% month on month, 2.5% year on year. As I say, slowest since 2021. Interesting, the black line here, just for your guide, that is a reading, the month on month reading is actually 0.17, which is needed or averaged over time that will deliver 2% year on year inflation as targeted by the Fed, of course. And you can see now we've had 2 consecutive readings, these blue bar charts, bars, if you like, below that level. So that is important for the Fed, of course, and also then actually the so-called super core measure that excludes housing, that even posted a negative month-on-month print for the first time since April 2020. So yeah, interesting readings, but of course, obviously, both the Fed and the market are worried by tariffs, of course. That will lift goods prices quite markedly in the coming months. That's what's expected. Then potentially that limits the Fed's ability, of course, to support the economy if we get weak, basically consumer survey evidence translating into sort of much softer, hard spending data. Interesting, I think, for tariffs and inflation. Obviously, everybody expects them to be inflationary and for CPI, PC to go higher. We've kind of stuck to the idea that they are a one-off step change to prices. Let's not forget tariffs. And just like previously in Trump 1, that's what the Fed looked at eventually. They looked through the tariff sort of price change really and presumed it would be a hit to growth rather than more. And that was more important than the lift in inflation because that was temporary. Also, if you think about it, the effect of tariffs, they will drop out of the annual price comparison in 12 months' time as well. So So yeah, a couple of things to think about there, really. And just remember, of course, the US is overwhelmingly a service sector economy, and the cost of employing workers is the biggest input, and that has slowed rapidly over the past year. So yeah, just a couple of things to bear in mind there for that data that we saw. Otherwise, moving on to the RBNZ, if I just pull up Kiwi against the dollar. Although this is obviously a chart which is moved by external events a lot of the time, more than just domestic events in New Zealand. But otherwise, yeah, moving on to the RBNZ, they cut rates by 25% to 3.25%, as widely expected, actually. But the overall message, interestingly, was more hawkish than expected. So first, well, there's a few points actually. First, the vote split 5-1 in favour of a cut. That was a surprise because the baseline was for a unanimous decision. Secondly, rate projections, they showed an average of 2.9% by year end. That's below the 3.1% from the February's update, but is not signaling then another 25 basis point cut to 2.75%. Also, finally, we heard from Chief Economist Paul Conway, who said rates are now close to neutral. And then Governor Hawkesby, he said, well, he sounded quite cautious, on future rate cuts, saying, I think he said, we have done a lot of work. So key takeaway, really, they're no longer committing to a set easing path. Any further moves now likely to be driven by incoming data. But yes, slightly more hawkish than expected, really. I'm just checking pricing for the next 25 basis point cut to 3%. Probably summer is most likely, but probably August, if anything, rather than July. There were already questions about whether rates would go below 3% this year, given the lack of inflation progress. And certainly now that sort of more hawkish tone from the RBNZ probably reinforces the view that there's only one more cut left, likely in 2025. And you'd kind of think then for Kiwi dollar, certainly then that move away from the sort of dovish stance that we have seen since July 2024, then that should be a, well, pretty good positive for the Kiwi. Just chart-wise then, you can see again, we've got the fib levels from this high in October 24 down to the low in April. We're just bumping up into the 61.8 retrace level, Fibonacci level that is, which capped the upside previously. You can see that's at 60.36. And you can see a few occasions where we got very close to it and then pulled back. So we're just sort of trading in this range at the moment, you would say, just above 60 down to where are we, 58.5 or so, but can't get above that 60 sort of level, 60.36. If we do, then next fib level is 78.6 level, which is at spot 61.86. Otherwise, yeah, support around the halfway point, probably 59.31. And then you've got the 200-day moving average there at 58.75. Interesting, blue is the 50-day moving average. Just double check that it is. So potentially golden cross if the blue 50-day crosses up through and higher above the 200-day. Just to highlight, they don't always work, often work for us. The golden crosses, death crosses, but anyway, just to highlight that potentially, then we could see a nice upside breakout, and especially as we sort of been trading sideways for a little bit, then potentially a breakout would be quite strong. Okay, that's Kiwi dollar. Briefly, I said I'd look at Tokyo inflation just briefly, just because it was interesting. Headline stayed actually at 3.4%, but core that accelerated to 3.6 from 3.4, beating the market consensus estimate of 3.5%. That means core inflation basically has accelerated quite sharply for 4 months in a row now. It was 2.2%, I think, in February, now 3.6 in May. And it just all supports really policy normalization from the Bank of Japan. Although it is in a sort of difficult position, of course, inflationary pressures, they remain hot, but then the sort of economic recovery, especially because of potential headwinds from tariffs, remains kind of more fragile. And then, of course, we had that recent hike. I'm sure you saw in long-term JGB yields, so Japanese government bond yields. That's kind of hurt market sentiment on growth and financial market stability issues, really. But ultimately, you have to say, rising long-term yields, that's basically a sign that the economy is normalizing as inflation is finally returning. So, yeah, again, a few things to think about for the Bank of Japan. Really, I think most expectations are for them to hike probably in July and then possibly pause until early next year. Um, Obviously, a lot depends on US tariff policies, of course, and then wage growth, always important for the Bank of Japan, and whether that continues into the new year. If we just pull up dollar yen, obviously this is again an important currency really for haven buying, really, or repatriation of yen back to Japan. Really is the case if we're being specific, and then that gives a bid to the yen, and you see dollar selling off. So dollar yen down again. Interesting, really. Possible support around these levels, 142 just above there, 142.10. Kept in this sort of descending bear channel. Obviously, we've broken out of it a couple of times now, so probably should take that out. But yeah, if we do break down below 142, then potentially you've got this 139, 140 area, which is a huge sort of support level. Just putting it back, you can see number of occasions, December 23, and then September 24, around this sort of 140, 139 zone, if you like, huge level of support. You can see we bounced off it a couple of times and big bounces. So yeah, we did that previously in April. So it's interesting whether we do break down through 142, then potentially we get to see 140 again. Okay, let's move on now to this week's main events. Let me just pull up what we're going to get through. Obviously, yeah, big few events, data, non-farm payroll is a big one. And then we do have those central bank meetings as well. We've just got a graphic actually with all the main numbers expected for non-farm payrolls. Hopefully yeah, you like these graphics. So yeah, consensus number just on NFP 130,000 versus April's 177. There were downward revisions to that number. Just remember those, or always be on the lookout for those. And the 3-month average, as I put, is 155k. 6-month average, a bit higher actually, 193k, I think. And then 12-month average, more like the 3-month average, around 157k, just for your guide. Jobless rate, that's expected to remain unchanged at 4.2%, so a touch below the year-end forecast at the moment by the Fed. That's 4.4%. And then average hourly earnings possibly ticking up to 0.3% month on month, but that's still fairly consistent with the 2% inflation target. I think markets then generally, I've got in here, we'll just get to this pricing in a minute. I think markets basically watching to see if, well, a couple of things. If the shock of Liberation Day, that feeds into weaker hiring possibly, and then if the Doge spending cuts are having any meaningful impact on federal government employment yet. Possibly too early to say. Just for your guide, sort of other employment data, so weekly jobless claims data that coincides with this survey window, that showed initial claims at 226,000 versus sort of 216, so a touch higher. That's a touch worse, possibly. And then Conference Board's monthly consumer confidence data that showed views of the labour market weakening in May, though the outlook was actually less negative than it could have been, really. In terms of the Fed, well, they're trying to balance, of course, above target inflation and a still solid labour market. And I think the recent minutes basically noted that the risk of higher inflation and higher unemployment have risen recently, and officials saw risks of the labour market weakening in the coming months and said it could face a difficult choice, basically trade-off between sort of persistent inflation while the labour market weakens. Those are obviously the two bits of its mandate: price stability, of course, and maximum employment. Of course, with this trade uncertainty that we talked about at the top of the webinar, then the longer that goes on, of course, then you would suspect the greater the loss of momentum in economic activity. I know lots of economists calling for this earlier than they should, and I guess if you say it so many times, potentially it comes true. It's just in the timing. Well, we're most concerned with the timing as we're trading these markets, but just that's a sort of maybe a wider theme. Of course, uncertainty just breeds more. Yeah, as I said, sort of a loss of momentum in economic activity potentially going forward. So that's the NFP data preview. Just on pricing, just above 225 basis point cuts expected then by money markets at the moment. Yeah, I put here sort of fully priced virtually for the first cut to happen in September, and only sort of just above a 1 in 4 chance of a first cut in possibly July. Unlikely at the moment, yeah, first one not priced till September. Also, just moving then from there, sorry, yeah, just also on other data, we do have ISM data shortly, actually, out of the US, manufacturing today, services on Wednesday. Generally, they may improve a touch, actually, given the subsequent de-escalation of tensions, of course, with China, the US and China. That resulted, of course, in tariffs on Chinese imported goods, being cut back to 130, being cut back to 30% from 145 or whatever they were. But of course, then we're getting this re-escalation, if you like, over the weekend with China as well, not helping, although that won't be reflected in these ISM survey figures. Let's look at the DXY chart, actually, which is the dollar index charts. We always like to bring this up, but we always do mention that, well, it's the index with 6 of the biggest trading partners of the US, but by far the biggest weighting in this index, don't forget, is the euro, around 56% or so weighting. So essentially, if you turn this chart on its head, you kind of get euro dollar, which is there just for your guide. But let's look at DXY before we go to the ECB, and then we can look at euro dollar. We used to have got this big dotted line in here. I think it's really important sort of pivot point. That's from this low back in July 23. That's at 99.57. You can just see we're trading around it over the last few weeks. Certainly this low from April is potentially, if we do push down below last week's low at 99.04, then potentially, if we stay down below here, then 97.92 key level, and it's that long-term low, which goes back to a 3-year low, I believe. Yeah, April 23 or so, 22, sorry. Yeah, so just looking at levels below that 97.92. And there's not a lot of major lows below there, really. So interesting levels. If you equate that to sort of 115 or so, that high in euro dollar that we'll look at shortly, then yeah, just watch out for this as it looks as though we're turning lower with this momentum, bearish momentum kicking in to kick off the week. Okay, we'll move on now to the ECB meeting just before we look at euro dollar. Just quickly, here's some expectations actually of the depot rate, and you can just see where we were in April, mid-April, and there now where we are. Expectations for rates going forward. This is so the higher red line means that we've basically mining markets have pulled back, reined in their bets on more rate cuts, if you like. A quarter point is definitely expected, a done deal really for us and for money markets at the meeting on Thursday, the ECB meeting. That takes then the key depot rate down to 2%. The question now really is whether the ECB pauses after what would be the 8th actual rate reduction in the past year. Most economists and markets really expect the ECB to hold steady come July before probably cutting once more before year end, as I think there's around sort of 54 basis points of cuts priced in for this year. So this one's a done deal, 25, and then another one potentially, yeah, as I say, after the summer, maybe, especially after July. Economy is holding up better than anticipated, really, in the Eurozone, and pausing, you would think, allows kind of the governing Council and ECB President Lagarde really time to assess the impact of US tariff drama, really, especially with, well, tensions, rising tensions, less tensions between US and China. And of course, then the EU-US talks are front and center as well. The 50% pause, remember, that's to July 9, I think. That's positive. But then, by all accounts, large gaps do remain between the two sides. We do get macro staff updated projections. And economists, I think, expect growth to be revised down actually a touch for both this year and next year, while inflation, that view is likely to be trimmed for 2025 to 2% from 2.3, but then increased to 2.3 from 2% for next year. Just in recent remarks, interesting, we thought Chief Economist Lane, he said he was confident that the bank's task to bring inflation back to 2% is mostly completed. So pretty confident with that inflation number going back to target. Just as an aside as well, during the press conference, probably Lagarde will be put on the spot about whether she's likely to complete her term. Actually, after a press report said that she held talks about leaving early to lead the World Economic Forum. Not policy based, but could be interesting towards the end of the press conference potentially. As I mentioned, we also get Eurozone inflation data. That's out tomorrow, Tuesday. That's expected to show headline inflation hit the ECB's 2% target in May. That's down from the prior 2.2, partially driven by lower energy prices and by a lower core. So core actually seen ticking down to 2.5% from 2.7%. The April increase, the 2.7, that was blamed, or can be blamed really, on the late Easter this year, and that should be reversed. Should just caveat that some, I think, economists think or had expected the core to remain sticky at prior levels, and certainly that was the case until we saw some of the countrywide data. So Spain's core figure that saw a marked easing, marked moderation actually last week, although that could be offset by the stickiness seen in the German core equivalent. Okay, let's just quickly grab the euro-dollar chart. Which is obviously dollar weakening, big time, euro doing well. We should say, and we've written about this quite a lot, just how the euro, single currency benefiting from investors moving away from the dollar, the euro being then the next biggest liquid, most attractive currency, really. So you can just see the blue line here, nice tap, really, a couple of times. So good support, you would think, of euro dollar. That's the 50-day moving average. That's now at 112.06. We've got fib levels in here. We kind of got to, we didn't quite get, to the 38.2. That's at 110.39. Obviously, all eyes on this high, 3-year high at 115.72. If we just pull it to the weekly, if we go above here, what's above 115.72, just sort of swing highs really then. So you've got that August one at 119. And then 116.92 is an October 2021 high. So yeah, interesting if we can get up to here. And you can just see bullish momentum picking up now in Eurodollar. Okay, just quickly, we'll go to the Bank of Canada meeting as well. Sorry, it's just taking longer than I thought. Don't see any questions either, so I hope all pretty clear for you guys. Just on the Bank of Canada, well, no rate cut here is expected, actually. Only about 5 basis points of easing, I think, priced in for this meeting. So that means around a 20% chance, 1 in 5 chance of a rate cut. So more than likely they sit on their hands. It was, though, I should say, it was a much closer call before we got recent quite hot inflation data. Before that data, there was kind of a 55-60% chance of a 25 basis point rate cut at this meeting. Yeah, we had a lower headline inflation print, but then the core has been moving higher again. Unemployment, that's in danger potentially of breaching 7% in Friday's jobs report. And then we also got actually a strong, decent, solid, actually Q1 GDP print. Of course, in amongst all of this, trade is critical to the outlook, given the importance, of course, of US exports to the Canadian economy. And of course, there has been some calming intentions, you have to say, but after Prime Minister Carney's visit to the White House to visit Trump, although, of course, we can't take anything for granted. Just on the prior meeting, the Bank of Canada's prior meeting, there was also no guidance actually due to all the uncertainties ahead. It is worth noting actually though the minutes of the last meeting found that the council was actually split on whether to cut or hold. I think those who favoured a cut, they cited near-term inflation risks and signs that the economy was weakening. So yeah, just for your guide, that's what the minutes said of the last meeting. Looking ahead, money markets, they're pricing around, I think, 35 basis points of easing throughout this year. So that's one more 25% cut, and then sort of coin flip between whether we get a second cut. Dollar CAD, then you can just see really interesting point actually, just near the recent lows, just around 137. We did break down, you can see this morning down at 136.73, but just pulled back above 137 again. If we do break lower, then obviously you've got this 134.20 as a key level for well, loony bulls, certainly dollar CAD bears, I guess. That is dollar CAD. Obviously, if they do cut, may see a bounce on this level around 137. But if we're sort of more, if they're more bullish, really, and wary potentially of that hot core inflation number, then you could see us breaking down through 137, I guess. Okay, I will wrap it up there, I think. Just checking, over 40 minutes. So yeah, really do appreciate you being on the call, all of you actually, for this length of time. I didn't see any questions, so I hope that's been clear to you guys. Please do follow us on social media, lots of different channels, and we do put a daily commentary out on the website after the US close, which has just a look at the dollar, equity markets, of course, and also a look at the day ahead if there's some important figures coming out, and also a chart of the day. Great stuff. Thanks so much again. Please do yeah, come back to us at the same time next week, and we will speak to you again soon.